Alright, we're now in part 3 of the Chapter 5 presentation, and I believe we left off with slide 45, so I'll just reiterate that real quick in case I did cover it in the previous one. So finally we have the non-operating activities that need to be recognized, although they were unrelated to the company's main line of operations. These are usually rather unique items, some of which occur most every period, such as interest revenue and expenses, and some of which are infrequent, such as losses or gains on the sale of property, plant, and equipment that is no longer used in the business. On slide 46, once we've determined the other items, what the other items are, both income and expense items, we add or subtract accordingly, showing the revenue or gain items first and then the expense and loss items to get a net gain or loss subtotal that will be added to or subtracted from the income from operations to get income before income taxes. Finally, the income tax expense is subtracted from income before taxes to arrive at bottom line net income. See the margin headings on the slide that breaks down the parts of the income statement and the purposes of each. Slide 47, you can see page 276 for a further explanation of this sidebar. The point is more clarity and transparency in financial reporting is needed so that users can better tell which items are not usual and therefore should be isolated in their disclosure versus lumped in with other operating costs or revenues. On slide 48, it seems like we had this slide earlier. Again, it's based on the formula beginning inventory plus purchases minus ending inventory equals cost of goods sold, or beginning inventory plus purchases minus cost of goods sold equals ending inventory. Revert back to this where we were talking about beginning inventory plus net purchases equals the cost of goods available for sale, and then further cost of goods available minus cost of goods sold equals ending inventory, or cost of goods available minus ending inventory equals cost of goods sold. So go to slide 49. Note in this chart how the purchase returns and allowances and discounts are shown separately and subtracted from purchases to get a net purchases amount. Also, how freight in is added since it is an inventory related cost. Note also the difference between cost of goods purchased, current period only, and cost of goods available, the cost of goods purchased plus the beginning inventory. This is important. When the formula was stated earlier as beginning inventory plus purchases minus cost of goods sold equals ending inventory, it was obviously simplifying things a little. As shown above, there's a bit more to it. But the key is knowing what goes into the cost of goods purchased. Gross profit is fun to analyze, and we're on slide 50 now, because it can tell you a number of things about how your profitability is going, depending on how you look at it. Comparison with prior periods, for example, can show possible trends upward or downward. You can see some of the potential reasons on this slide that may contribute to a lower gross profit rate. The first thing is to compute that rate so that you're aware that there may be a problem. On slide 51, why does Walmart have a lower gross profit rate than the industry average? Could it be that they sell so much stuff that they can afford to have a lower gross profit rate? That in fact, if they strove to increase that percentage, they might just lose some of that sales volume. The text points out the expansion of the grocery business, which is a low margin portion of the business, and that may have something to do with it too. Target, on the other hand, in order to expand its market share, might consider lowering a few prices to be more competitive with Walmart. Just a thought. On slide 52, the profit margin ratio, unlike the gross profit ratio, measures the percentage of each dollar that results in net income. That is, how much the selling price covers all expenses, not just the cost of goods sold as the gross profit rate measures. It's simply computed by dividing net income by net sales. On slide 53, again, because Walmart is in a high volume, lower margin business, groceries and lots of other low price goods, it's not surprising that its profit margin ratio is slightly less than the industry average. In addition, as noted in the text, Walmart had higher operating expenses in 2009 for several reasons, and this lowered the profit margin as well. What does 3.3% mean? Well, for every dollar of sales, Walmart made 3.3 cents of profit or net income. On slide 54, this vignette shows the value in understanding your operating costs and how changes in selling prices can affect gross profit and profit margins. As the text states on page 276, if two or more competitors get into a price war, the one with the lowest operating costs will probably win that war since they will still make some money. That is, the profit margin will still be positive. On slide 55, this slide presents interesting food for thought about the quality of a company's earnings. By using the quality of earnings ratio, it can be seen how much of the earnings is backed by actual cash receipts versus promises to pay on account. On slide 56, let's delve a bit deeper into the periodic inventory system and how the accounting differs somewhat from the perpetual system we've been discussing. First, to reiterate, in the periodic system there is no continuous count of inventory every time units are purchased or sold. Instead, there is a physical inventory at period end that determines the ending inventory, and from that, the cost of goods sold can be determined. Another notable difference between perpetual and periodic is that in the periodic system, purchases are recorded to a purchases, that is a debit or asset account versus directly to inventory. This makes it easier to see the logic of the formula presented several times thus far, that is, beginning inventory plus net purchases minus cost of goods sold equals ending inventory. And again, just to reiterate that here on the board, so again, beginning inventory plus net purchases minus cost of goods sold equals ending inventory. And remember that net purchases consists of the purchases minus returns and allowances and minus discounts. So all that is tied up in the calculation, because if you get net purchases, you have to recognize not just the gross amount of purchases, but subtracting any returns and allowances and any purchase discounts. On slide 57, note how SOC, which is our buyer here, I believe, which in the perpetual system recorded this purchase of merchandise directly to the inventory account, now records the same purchase to the purchases account under the periodic system. And on slide 58, the same thing with freight costs that are now debited to the freight in account versus the inventory account under the perpetual system. Freight in, again, is basically an expense account. Going on to the purchase return illustrated earlier, notice here that the credit entry is through purchase returns and allowances account, a contra asset credit balance account, versus directly to inventory as it was using the perpetual system. And the same type of difference applies in the entry for payment to PW Audio for the items purchased. Instead of charging, that is crediting the inventory account directly for the $70 discount, it's now credited to the purchase discounts contra asset credit balance account. Otherwise, the entry is the same. On slide 61, the difference here is that unlike with the perpetual system, cost of goods sold is not recognized with this individual purchase of merchandise. Rather, cost of goods sold will be computed at the end of the period under the periodic system. So you don't see an entry for it at this time. On slide 62, note that on the sales side of it, we've already established the sales returns and allowances account, and this does not change with the use of the periodic system. However, what does change is that there is no associated entry to debit inventory and credit cost of goods sold for the cost of the merchandise returned under the periodic system. Remember, with periodic inventory, this is all figured out at the period end. And on slide 63, there's no difference here between the perpetual and periodic systems in recording the cash received in payment for the merchandise sold. That's because the cost of goods sold were already accounted for in a previous entry using the perpetual method. You can see page 236 of the text to observe that. Slide 64, this slide summarizes the entries made throughout the month using both the perpetual and periodic systems. Note again the similarities and the differences, as these will be included in future quiz and exam questions. So it's important for you to know that. And here are the remaining entries for comparison between the two systems, with the perpetual in the middle in blue and the periodic in red on the right. As far as IFRS, this slide here really tells you about all you need to know. And again, I've indicated that I won't actually quiz you or include questions on the exam on this subject, but it's good to know stuff because the world appears to be moving in this direction. And it says under both GAAP and IFRS, a company can choose to use either a perpetual or a periodic inventory system. So that's basically what you need to take out of this chapter regarding IFRS. And with that, we'll conclude the presentation on Chapter 5.